The stock market increased by nearly 20% in 2017, so it can be easy for investors to forget about another contributor to their bottom line, the dividend. In this morning's U.S. Bank Economic 360, Senior Vice President Mike Denneman joins Business Courier publisher Jamie Smith, actually Rob Dahlmeyer, today to talk about dividends and why they are still a matter in a booming market. Mike and Rob.
Thank you, Peg. I'm not the publisher, and I'm not Jamie, but I am Rob, and I'm the editor. First things first, Mike, tell everybody what a dividend is.
Sure. So, put very simply, a dividend is your share of the company's profits. And we've talked a lot on this program over the years about how buying a share of stock makes you a partial owner of that company.
Right.
And naturally, like any owner, you're entitled to a share of the profits. So that's what the dividend is. You know, after all the revenue comes in and all the bills are paid, the board can decide to take a portion of what's left over and distribute it among the shareholders. And so dividends most often are paid on a quarterly basis. They're most often paid in cash. They simply send you a check. Here's your share of the profit. So granted, most investors will buy a share of stock because they're hoping it will go up in value. But if you buy a share that also has a history of paying a dividend, having that quarterly income stream that's a pretty good feature too.
Right, but so especially when markets are going up, this has been a great year for the markets in general.
Right.
How easy is it though to forget about that dividend piece?
You're exactly right. It can get overshadowed pretty quickly. To put it in context, say the market is up this year about 20%. On the other hand, the average dividend in the market is about 2%.
Right.
So, you know, what's going to get more headlines? High-flying stocks making record closes, or a small quarterly income stream. So yes, it can be easy for the dividend to be overshadowed in this kind of environment, but that doesn't mean that we should forget about it totally.
Right, so the key for me is, and it really comes down to this, how important are dividends? There's a lot of great companies out there that have nothing to do with dividends.
Right, right. So here's one way to think about it. A lot of investment philosophy is built around this concept of what's called total return, which has two components. One is the share price growth. The other is the income, which in this case is the dividend. So again, when the market is really roaring, you're going to focus on the growth and less on the income. But remember that the market isn't usually roaring. Usually it's performing less than that, oftentimes much less than that. So instead, imagine an environment where the market is up only, say, 4 or 5% this year. For the income to be another 2% on top of that, that can make a pretty big difference. And so, granted, dividends are not flashy, but in a more normal market environment, or even one where the market gets rough, which it always does eventually, we know that, having that income stream, having that 2% dividend, as paltry as it may seem in today's environment, that can be pretty valuable.
It's great advice. I think what you said, dividends aren't flashy, but boy, they sure do. They sure do create a higher basement when things are going bad. Thanks so much for being here.